Hello, Rebel Capitals. Hope you're well. So we've got a lot to talk about today. Ed Dowd, formerly from BlackRock or Blackstone. I should know that. I'll look it up in a second. But one of my favorites, experts, market commentators, is out warning of a deep recession. So we want to really pay attention to what Ed is saying. Really smart guy. We're going to get into the details in just a moment. Also, along the lines of recession, a banking expert came on a podcast that I'm a big fan of the other day and was talking about how he sees a downturn in housing. So what I did is, believe it or not, some research. And I looked up what the housing market is as a percentage of GDP. Because we hear Warren Buffett talk about the Buffett indicator all the time. That's basically the market cap of the stock market relative to the US GDP. Well, it's overvalued, undervalued, etc. Well, I wanted to do the same thing for the housing market. That's not to say that it's the same concept that this tells you that the housing market is undervalued or overvalued or whatever. Obviously, I don't know if the same correlation would hold true, although I think there is some overlap there. What I'm more so looking at this through the lens of how important is the U.S. housing market to the U.S. economy. Also here, we've got Michael Saylor coming out with his new company named Strategy, right? Well, they've got a new strategy. They've got a new Bitcoin strategy, and I think it's worth analyzing to the extent to which we can. It gets very convoluted and rather complex. But I think at the very least, regardless of your view on Michael Saylor or what his strategy, no pun intended, is, it's fascinating. Really interesting stuff that I think we need to pay attention to, especially if you're concerned or if you're interested in the price of Bitcoin over 2025. Then lastly, market way up today. But I think what's more meaningful is why it's up, and are we going to see more or less of this moving forward? And is this just a counter trend rally, or is this a new bull market where we're going to go back up to all-time highs? All right, so let's get into it, guys. First and foremost, and we're going to go over to Zero Hedge. Ed Dowd fears a short but deep recession coming as Doge exposes mind-shocking fraud that propped up Biden's economy. And I think, I really enjoy listening to Ed, and I strongly suggest, I believe he's on Twitter, but following him wherever he is. And I'm going to give him a shout out here with his website, finance, spelled PH, technologies.com. You got to check that out. So former Wall Street money manager, and just for my own personal curiosity, where did Ed work? I think BlackRock. There you go. It was either Blackstone or BlackRock. Yeah, BlackRock. Okay. Investigators have uncovered 115 billion so far, with many hundreds of billions more to be exposed. He said both sides are guilty, which I completely agree there. The Doge revelations are mind-shocking. The clear way in which government was spending money through NGOs and people taking kickbacks and profits. Basically, what he's saying is that if this is going away, that's a good thing. But in the short run, it's likely going to impact aggregate demand because it was such a big component of the U.S. economy, as sad as that is. So Ed wrote a paper, which again you can find on his website, and it's this report. He said, we were surprised on how fast Doge would get to work. This is why our thesis is playing out a little quicker than they thought. The housing market was on fragile ground last year, so it was held up by illegal immigrants supporting rent rates. Yeah, I don't know if I'd agree with that too much, but so as that unwinds, we think there will be mini 2008, 2009 housing issue. Housing prices are going to come down. That's a big driver of consumption in the U.S. economy. Now, this obviously I completely agree, and we're going to get into the new Buffett will call it the Gammon housing indicator in a moment. That needs to happen because home affordability is off the charts. Yeah, that's the downside to home prices going up. Everyone thinks that, oh my gosh, we always want asset prices to go up higher. That's if you're a seller Or if you own assets, yeah. But if you're trying to buy assets, which is a large portion of the US society, then you want lower prices. You don't want higher prices. We just always tend to look at whether it's bad or good through the lens of the people that already own the assets. So Dowd also sees recession coming as government downsizes. Consumer confidence has taken a nosedive. Absolutely true. There are 10 million to 15 million illegal immigrants worried about the gravy train coming to an end. Yep. I mean, who knows what was going to these people? I always tell the story of when I was spending some time in Nogales on the Mexican side. And just long story short, there was a guy that I knew over there, and he would tell me how he crossed the border like a couple of years ago or something like that, and got like this card. And initially, he went over to get the card illegally, by the way, to get like a $2,000 payment or something like that to people crossing the border for whatever reason, whatever government program was going on at the time. And he said that he was supposed to initially just get like a $2,000 payment, like a $2,000 prepaid debit card or something like that. But he said every single month, the government adds another $400 to it. It's like, this is amazing. I just get a free $400 every single month. And he's not even in the United States. He went back to the Mexico side and he still gets the $400 or whatever it is every single month. So who knows? I mean, what's going on? And I think Ed's point is hopefully if they get to the bottom of this, that's a good thing, but that will likely decrease spending quite significantly, maybe more so in Mexico than it will in the United States. Dowd likes gold as a core asset. Makes sense. He says the problems on tariffs are overblown. Yeah, so I don't like the tariffs from an economic standpoint. That's for sure. But I do agree with him that the way the mainstream media is painting it is overblown. Look, I think it's a net negative. Do I think it's catastrophic? Like, like the mainstream media is leading you to believe? Nah, come on. But I guess that depends on to what degree they're implemented. I mean, if you told me, hey, he's going to implement a 200% tariff on everything coming into the United States, okay, now we're talking catastrophic. But he's not even floating that. And I think most of what he's talking about really isn't going to come to fruition because he's more so using it as a negotiating tactic. And in that case, I think it's a good tool. More on that in the last topic of discussion here on this live stream. Dow sees deflation and possibly a short but deep recession coming before inflation. I couldn't agree more. Maybe deflation. I don't know. Definitely disinflation. I would not be surprised if over the next 6 months, year, the official CPI gets below the Fed funds rate, or below the Fed's target rate of 2%. Would it go actually negative? I mean, if the central planners step back and just let the free market work, absolutely, I think we'd have deflation. Absolutely. But I just think they really, since Greenspan, they've had more and more of a hair trigger, if I'm using that term correctly, where at the sight of bad news, they're just immediately doing something, right? To the point where during the cerveza sickness, I mean, it's like 2 weeks in and they're bam coming to the rescue. So I don't know. I guess there's two questions. How long would it take them to respond to, let's just say, a recession type event? And then what would be the efficacy of their programs? Because that's something that people always assume that, oh, well, we've got a Fed put. Maybe. I mean, we didn't really have one during the cerveza sickness. To me, that's a misconception of what happened. If you go back and actually look at history, and I know it's reporting on it every single day, when the Fed put came to the rescue, the market basically gave them the middle finger. The market kept going down, even after Fed dropped to 0%. And remember when they announced up to like $1 trillion a day in repo and all these things and QE unlimited or QE forever, and the market still went down. The market didn't really rebound until we came out with fiscal. So with Doge and Elon and Trump and everything that's going on, how quickly will the government respond with fiscal? I don't know. It'll take more time than I would assume if Kamala Harris or Joe Biden was in office. But It's just, what are the probabilities, right? I mean, how much pain would Donald Trump be willing to withstand before he steps in and makes an excuse as to why, under these circumstances, and the way he's going to increase the size of government or going to do fiscal spending or fiscal deficit spending is going to be fantastic and great and the best thing that you've ever seen. Whereas if Joe Biden did it, well, he's the worst president in human history. So, you know, the way Trump likes to spin it there. But my point is, the longer they waited to implement the fiscal, I think the higher the probability of deflation if you get a recession. And the more knee-jerk reaction they have to it, then I think I lean more towards disinflation. I do not see an environment where you have a recession, especially a deep recession, that is inflationary, meaning not that we have consumer price increases, but that you have an acceleration of the CPI. So in a recession, obviously we're adjusting for the rate of inflation there. So in real terms, we have a contraction of GDP over 2 consecutive quarters while we have a spike in unemployment as the CPI goes from 2.8 to 3 to 5 to 7. And the reason I don't see that as a high probability is because you go back even to the 1970s, and all the recessions that we had were all disinflationary. None of them were inflationary, where inflation was actually increasing or accelerating. So then he talks about how it would be a plus for the U.S. to stay out of any conflicts. Couldn't agree more there. So now he's talking about a black swan event. This is interesting. I didn't see this before. Another black swan event is a Bank of Japan currency crisis and also something going on with Iran in the Middle East. Black swan events add to the risk, are hard to predict, by definition. Yeah. And then here is his new report that you can find. It's Danger of Deep Worldwide Recession in 2025. And you can find that at finance, spelled PH, technologies.com. And then I guess Ed has a book called Cause Unknown. And then you can find that, I'm sure, on his website. So now let's go over and check out kind of this new indicator. And again, I don't know if I would really use it the same way as you use the Buffett indicator to find out if the market cap of XYZ asset is overvalued or undervalued. Although I think there would be some correlation there with the housing market and the U.S. economy as in reference to whether or not the housing market was overvalued. But I'm not looking at it through that lens, just to be clear. What I'm pulling this up because I want to look at it through the lens of how important the housing market is to the overall economy. But, I guess you could look at the Buffett indicator that way as well, right? I guess you'd have to look at, it being 200% of GDP or whatever it is right now. And then how many of those retail investors own stocks, what percentage of their net worth it was. But I think it's just kind of a broad proxy. You could come to some conclusions there for sure. But let's go over the GDP, now nominal terms here, guys. And let's start with where we were. Let's go back to 2000. So right at 2000, 2001, GDP was, call it 10 trillion. So now let's check out this chart. And it goes, I don't know why, they don't put the year down here. That's annoying. But we can see it goes from 2000 to 2024, the end of 2024. So back around 2000, it's about 10 trillion. So about the same. It's about 100%. And then when we get to the peak of the real estate bubble, call it in 2006, the real estate market, and this is residential, just to be clear, residential real estate, right around, call it 23 trillion. So now let's look at what GDP was. There you go. So now you see the home prices accelerate way faster than GDP. So just so we're all on the same page, right around here, the housing market was about equal. So I guess you'd say 100%. 100% of GDP, both 10 trillion. Then we fast forward to 2006, and we're right around 13, 14 trillion on the GDP side of the equation. But we are up to 23 3 trillion, call it. So, wow, you had a massive increase there. You had an increase of, call it 13 trillion in the residential real estate market, the market cap, if you will, the value, the total value. And you only had a, call it 3 or 4 trillion increase in GDP. Okay. So now let's fast forward to where we are today, because I want to compare that with 2000 and 2006 for obvious reasons. And we're right around 30 trillion on GDP, 30. Let's see where we are on the. So in terms of the housing market, we are, yeah, so it looks like we're right at 50 trillion. Okay. So I almost flunked out of high school, as most of you know. So I'm gonna have to do the old calculator. How should we do this? So we do right at 2006, we were at 22 trillion in okay, so if we were at 22 trillion divided by, let's call it 13. That was, so we're right at 1.6. So then what we would do is now we are at 50 trillion. Well, I can already tell you it's more. So now we're at 50 divided by 30. Oh, well, right around the same. Right around the same. Not that that's comforting, because we're at the same levels as we were at the peak of the biggest real estate bubble that we have ever seen in the United States. So there you go. And I guess my overarching point would be, regardless of how precise that math was, it's all about the concept, right? Think about how important real estate was to the U.S. economy back in 2006, just pre-GFC. And if you want to know the answer, all you have to do is think back to 2009 to 2012 and ask yourself, what was the economy like back then? And for the younger people that might not remember, I remember it well. And it's just all the anecdotal stuff, such as trying to get a reservation for a restaurant. 2009, 2012, you didn't need a reservation. The restaurants were relatively empty. I remember putting an ad on Craigslist in 2012 for construction, just like handymen. Within an hour, I had 100 resumes. You fast forward to 2015, 16, 17, I ran the exact same ad. I can't remember exactly what year it was. Exact same ad, and 3 days, and I'd get 2 resumes. That's the difference. So my point is, it was crystal clear to anybody paying attention how important the housing market was to the U.S. economy just pre-GFC, when everything hit the fan. And the bottom line is we're pretty much at the exact same level now. I would argue, even though this ratio is similar, we might even be more dependent on asset prices, because since 2019 and the government's response to the cerveza sickness, especially with the poor and middle class, we have seen their purchasing power go down. I would argue the purchasing power of the poor and middle class was, even stripping out assets, was better or higher in 2006 than it is today. So I think when you add that variable, I think there's a strong argument how we would be even more dependent. And again, this doesn't even include the stock market. When you include that into the mix, it's like I always say, it's the economy is completely inverted. You just have this inverted pyramid, and the bottom is just asset prices, and everything is kind of teetering on those asset prices. And oddly enough, when you look at the stock market, it's not even the stock market, because the stock market is the Mag 7, and the Mag 7 is NVIDIA. So, I mean, you could argue that the entire U.S. economy revolves around the Mag 7 and housing. So why is this important? Because now I want to encourage all of you guys to check out a podcast episode, great podcast, right here from Monetary Matters. Now, this is Jack Farley runs this. He was formerly with Real Vision. A really good interviewer, and very good, very doesn't really have a bias. He really tries to get to the bottom of what the interviewee is discussing what their major talking points are. Very good. So I'd strongly suggest it. Although, Jack, if you're listening, just take it from a guy who's pretty good at YouTube, that being me. You got to work on the thumbnails, my friend. The thumbnails are too busy. The thumbnails are way too busy. Clean up the thumbnails, buddy, and you're going to get a lot more views because your content's fantastic. But anyway, he just interviewed a guy named Chris Whalen, who's a banking expert. And you guys can see the title here. A foreclosure wave is coming. Now, he's not an expert on the real estate market, but he is an expert on mortgages, looking at it through the lens of the banking system, mortgage-backed securities and whatnot. And his argument is, now that we've got Trump in office and Doge and Elon and everything, they're going to be making an effort to get government out of the private sector. Well, what private sector or what component of the private sector is most heavily subsidized by the government? That'd be housing. It's housing. And you say, George, I don't know. I don't get it. How are you connecting those dots? Because first and foremost, the 30-year fixed rate mortgage. Most countries don't have that. Why? Because it's a money loser. The bank would never do that because there's just way too much inflation risk over the long run. That's why it's not really a free market loan. It has to be subsidized or guaranteed by the government, i.e. the taxpayer. See? And if you go to other countries, Canada, Australia, etc., you're not going to find a 30-year fixed rate mortgage because that mortgage is likely going to be on the balance sheet of the bank. And if it is without any guarantee, there's no way the bank's going to do it because there's too much risk. And they're most likely going to lose money on it. So that is one of the reasons, just one of the reasons. And then you got the FHA and all these other programs by the government to incentivize home ownership. Ironically, right? Because it just incentivizes homes going up, that's for sure. But the price of homes going up to a large degree eliminates a lot of the buyers, even with these programs that are meant to encourage more, let's say, home affordability. All they do is they jack up prices and make them less affordable over the long run. But again, Chris's point is that the Trump administration, Elon, Doge, are going to do their best to get the government out of the housing market. And if they get the government out of the housing market, the Fed's not buying mortgage-backed securities. Maybe they, who knows? Maybe they eliminate Fannie and Freddie. Maybe they stop guaranteeing the 30-year fixed rate loan. And therefore, all the banks have to do this lending themselves and keep it on the balance sheet. Okay, now what are mortgage rates going to be? And then what is the housing market going to look like if you can no longer get a 30-year fixed rate loan? The answer is a lot different. And so this is why he sees quite a bit of downside risk, he meaning Chris. So again, I'd strongly suggest listening to this interview. And by the way, it's got 17,000 views, which is very high for the channel. Which tells you just how great of an interview this actually was. And obviously, this dovetails perfectly on what we were saying before with the Gammon housing indicator that's just basically looking at the housing market cap as a percentage or in relationship to GDP to kind of understand the dependency that we have in the U.S. economy towards this asset class. Unfortunately, it's all assets, really. Hey guys, I'd like to personally invite each and every one of you to attend this year's Rebel Capitalist Live. This is the incredible conference I put on annually that helps you build a bulletproof portfolio. It helps you increase your personal freedom and liberty, and also it helps you increase the size of your network. In other words, you get to meet a lot of like-minded individuals, fellow Rebel Capitalists. It's in Orlando, May 23rd through the 25th. Past speakers have included people like Robert Kiyosaki, Ron Paul, Peter Schiff, Mike Maloney, Lynn Alden, just to name a few. So to get your tickets ASAP and to find out who is speaking at this year's Rebel Capitalist Live, you can check it out at rebelcapitalistlive.com. And just a little quick insider information, if you get your tickets sooner than later, you can get a discount because as we get closer and closer to the event, the tickets go up in price. So don't wait. Go to rebelcapitalistlive.com right now and get your tickets. And I will see you in Orlando, May 23rd through the 25th.